Hi, it's Lori Richardson with Cornerstone Home Lending. On Monday, November 14th, just wanted to give you a quick peek at the markets. As we all know by now, we saw the results of the presidential election have a massive impact on the markets last week. And we just have seen significant volatility in both the stock market and the bond market as the investor expectations for what does the U.S. economy look like under the Trump administration have really become the focus. As a result, we saw mortgage interest rates end the week at the highest levels that we've literally seen all year. Now, I'm going to list out below a little bit about what we saw happen both the night of the election and the next day after the election, just in the markets, because I think it's important to see what happened, what the psyche was that kind of created what we saw, because I think our clients are going to have questions about that. So take a look. Okay, so the very biggest question that I'm getting from my clients right now is, now what? Given the new administration, what does that mean for U.S. housing, mortgage interest rates, and the like? And if you recall, throughout the campaign, Trump advocated for both increased spending on defense and infrastructure, so roads and bridges and hospitals, but he also talked about cutting taxes. Both of these policies raise the prospects for increased deficits and inflation. And if you think about it from a macro perspective, you'll remember that inflation and increased deficits are bad news for the bond market. And so we will likely see mortgage interest rates increase as a result of that. Now, the big thing I wanted to mention here is I talked to a couple of clients today who have seen all of these posts on Facebook with regard to, how great the stock market is doing. And there's a disconnect between how well the stock market is doing and the fact that interest rates are increasing. And I just want to remind everybody that there is an inverse relationship, generally speaking, between the stock market and the bond market. So when we see stocks rise, we see bonds fall, which means that mortgage interest rates rise. Now, in the long run, increasing interest rates in this environment right now, given the fact that we've been subject to so much government stimulus over the last couple of years, is really a healthy thing. And it means that we're returning to, or we could be returning to, a more normalized, healthy mortgage market. So from a macro perspective, I just kind of want to hold that in check and remind people that as we see this continue to go on, increased interest rates, even though they could be painful in the short run for folks buying right now, could be a healthy sign of an improving economy over time. So this week we will see retail sales come out on Tuesday. On Thursday we will see housing starts and the consumer price index, just to kind of give you an idea. And in terms of rates, we're still sitting in great shape. We're still in the low 4s for a conventional conforming loan, in the mid 3s for FHA, and in the low to mid 4s on a jumbo loan, just in general. It'll tell you how old I am, but when I got into the business, rates were at 18.5%, so I will take 4% any day. Anyway, if we can answer any questions for you or help in any way, please reach out, 720-200-6868. Hope your day's great.